Good morning, it's March 18th, and this is an audio update primarily for the interest rate markets, dollar, and we'll talk a little bit of the stock market. Now later today, I'm going to put up a free video. We're going to try to expand into more of the global markets and then some sector markets within the U.S. market. Those may only be updated once a week and sometimes even less frequently, and they'll probably be separate reports. I may even strip out the global markets from the weekly update for the U.S. stock market. And then what we want to do is look at ratios, in other words, of relative strength of those sectors and global markets versus U.S., see if there's some investing and trading opportunities relative to our model analysis that will always remain primarily focused on the U.S. Okay, so what's going on in the U.S. market? Well, the interest rates yesterday backed off after the FOMC meeting results and Fed Chairman Powell's comments. And I think Powell kind of left some pressure there, some tension, some worries, some concerns. Stock market rallied nicely, and yet this morning it's totally reversing that rally because of interest rates decided to move still higher. They're up to now 1.737% for the 10-year note. We haven't even started the day session yet. I was kind of hopeful 1.7% would act as a major resistance, if not the 1.6 area. I think the market kind of wants 2%. They want to get it over and done with. I'm pleased the stock market acts as though it's trying its best not to pay much attention to interest rates, but the very short-term traders can cause problems and complications, and there can be this fears of interest rates rising way too fast, okay? So, well, obviously we're stuck with that. We'll have to deal with that. And as I've said for quite some time now, we'll have to deal with rising interest rates all of this decade, perhaps even next decade, relative to a super cycle that just turned up and put an end to a 40-year bear market in interest rates, okay? Now, inflation has also turned up. It probably turned up even back from the 2000s, but you could make an argument it turned up last year or the year before and a little closer to the interest rate super cycle. So inflation can rise this decade, perhaps next decade as well, okay? You still will get those once-a-decade recession setbacks in rates and inflation. Currently, the rates are rallying faster than inflation, and this has caused some buying in the U.S. dollar market, okay? And it's, of course, caused some concerns in the stock market. Yet I zoom out for this year, and I find the stock market has actually been working higher. It's doing its best at dealing with higher inflation, higher interest rates. It's trying to acknowledge the fact that when we're in early inflation, especially when coming out of a recession, then rising inflation and rising interest rates is actually a good thing. But again, if these rates want to shoot up, on a short-term basis, something really fast, it's probably going to give us some problems here for we bulls. And I am still bullish the U.S. stock market into summer for the level 1 trend. I'm bullish for at least a few weeks here for a level 2 trend. And I think short-term, there's a chance that we just put in a level 3 bottom. That would be your intra-month to monthly type bottom. I think we put it in place, but we have a few days yet to deal and work with it, okay? Now we move over to the dollar market. Or first of all, in the bond market, it does look like over the next few weeks, bonds should move back up, therefore interest rates should come down. But as of this morning, we have no signal, no sign of that occurring. And that would just be for traders. It's intra-year kind of fluctuation, okay? Now in the dollar market, it reversed, it started down a little bit as of this week, that they liked the Fed comments. Now it's resting here this morning. It's basically at the open of the week for the U.S. dollar index, and it's basically trying to ask itself, does it really want to rally along with those U.S. interest rates rising? If U.S. interest rates rise faster than some of the global rates, they're going to buy the dollar and sell currencies of those global rates. So I want to watch out for that. Ideally, the dollar is setting up to decline over the next few weeks, which is why I think eventually the stock market moves higher, interest rates back off, but we don't have any evidence as of this morning. Now, the gold market's trying to move up a little bit, but the problem is it's already due for a level 2 top, and now in the next few weeks, I'm concerned gold's just going to remain sluggish for some time. Over in the Bitcoin market, I pulled out too soon on my own personal trade, called a top in place, and then I reran the model, and the model's saying, well, it is in the time frame for a top, but ideally it probably has not topped. So if a dollar index is going down, they may buy the Bitcoin, although you have to be very cautious of that relationship. It doesn't work as well as with other types of currencies, okay? And I don't have anything to say on the crude oil this morning. It is time for it to consolidate and correct a little bit, but I think it's probably in a long-term bull market, although I continue to believe upside is rather limited for that. So a little later today, we're going to take a look at some of those global markets and some sectors. And I'm going to look at some 2X ETFs. They're some of my favorites, some of them at proshares.com. And we're going to do some ratio studies to the SSO fund, which is actually a 2X S&P 500 index fund. And can we see some opportunities there where maybe it's time to buy some of the lower priced markets, or should you stay with what's kind of high priced because they're relatively stronger and have higher to go? So we'll discuss that a little bit later today. Any rate, to get back to the U.S. market here, on the stock market side, it is concerning that they've pulled this back as much as they have. I'm rather hopeful we're going into what I call level 4 bottom. That may still be some kind of level 3 base building here. And as I look out over the next few weeks, I think the market's going higher. But as I warned you yesterday, the level 3 bottom that ideally will show up this week and maybe the start of next week, you could see how a level 3 downtrend would allow for as low as 3850 in the S&P 500. I'm rather hopeful it hangs on to 3900. I'm hopeful that it's consolidating here, base building, to eventually break through 4,000 on the S&P 500 index. Manage your risk relative to analysis of others and your own. Have a great day. Thank you. And remember, tomorrow we'll do the weekly update for the U.S. stock market. So if you're not a subscriber, you want to get on board to that and see what we're doing, because you can see all the fluctuations previously. And by the way, I do have a managed account program. People can put money in, and when I make a trade in the master account of my own money, you're going to get an equivalent trade of that in your own account. It's going to trade for some of these level 1, level 2, intermediate, intra-year swings as one type of performance, one program or tactic. And it's going to trade ETF stock indexes only. I do not trade individual stocks. I'm a macro investor. Then it's going to put a smaller portion of the total portfolio in the long LT3 program. That is long-term, where we want to be bullish for the decade, and then we want out because of a recession, and we'll want out of everything at that time. And that particular performance has done very well since 2010. And contact me for details, rich@ag-financial.com. I'll explain it to you. And I'm combining those two programs, if you will, for the total return. Something really long-term where we almost like buy and hold. We don't want to manage it too much, and we don't want to take profits along the way. And then we have this other position where we are taking profits along the way and resetting at times, repurchasing, trading some of the bigger swings during a year within this long-term bull market. And I've done this since the 2000s with my own money, and it's performed very well. And so take a look at that. I think it's going to be a great diversification compared to what people are normally doing in the market, especially if you're a stock picker. So have a great day, and thank you.